Hello and welcome back, students. Now, in the series of ratios, accounting ratios, we are here to study the next type of ratio that is known as the activity ratios or the turnover ratios. Okay, so in this, we'll first discuss how many ratios are there in this one, and then after that, we will analyze and we will study each of them in a separate manner. Now, so in the activity or the turnover ratios, now what is the meaning of activity? Activity simply means the working which is going on in the business. Now, what are the type of workings? For example, the goods are being purchased. Next, there is a production activity going on. Next, apart from that, there is a selling activity as well going on. Okay, so these are the activities which are going on in the business. So according to these activities, what are the ratios? Are we able to produce the goods on time? Are we able to sell the goods on time? Are we able to get the money from the customers or the debtors on time? And are we capable enough? Are we able to pay the money to the creditors on time or not? Whether we have so much of production, whether our goods getting sold or not in the market, whether we have a surplus of the goods of the closing stock or not. These all things we will be studying in this ratio only. So this is the meaning of activity. Now the question arises, what is the meaning of turnover? Turnover simply means the amount of goods which is being purchased and sold. So turnover as in the how many times we are purchasing the goods and how many times we are selling the goods after the production is complete. So this is basically the meaning of production, that is the turnover and the activities. So now let's begin with the types of ratios which appear in this activity oblique turnover ratios. So the first one is the inventory turnover ratio. The second one is the trade receivables turnover ratio. The third is the trade payables turnover ratio. Fourth is the working capital turnover ratio. Next is the fixed assets turnover ratio. Last is the net assets turnover ratio. So in total, there are 6 types of ratios under the head of turnover, that is activity ratios. Okay, so now let's begin with the first ratio. The first ratio is your inventory turnover ratio. What is the meaning of inventory? Inventory simply means the goods available to be sold in the market to the customers. Okay, so inventory is basically the stock. The stock can be of many types. There are 4 main types of stock. The first one is the stock of raw material. The second one is the stock of work in progress. The third is the stock of finished goods. The last is the stock in trade. So what happens is our business can be of 2 types. The first type can be the production company. We would have a factory where we produce the goods. So we are a manufacturing industry. Or else we could be the trading company as well. Now what is the meaning of trading company? Trading company's main work is to purchase the finished goods from the market and sell those goods to the ultimate customers. Like for example, if I take an example for a general store, they simply purchase the goods and they simply sell the goods to the customers. Okay, this is the scenario of a trading company. Next, the production company manufactures the goods. They simply purchase the goods, that is in the form of raw material. Then they process the same. They manufacture the goods, the finished goods. Then after that, after being preparation of the finished goods, they sell into the market. So this is the scenario of your company's type. Okay, so that's why we have 4 types of stock available with us. So now we are here to find out the inventory turnover ratio. Now, what is the meaning of inventory turnover ratio? The formula, let me just explain you the formula. Then it will be easy for us to understand the meaning of this ratio and why are we calculating this ratio. The formula for this is cost of goods sold, that is cost of revenue from operation upon average inventories. Okay, I repeat once again. The formula for this is cost of goods sold, that is cost of revenue from operation upon the average inventories. Now what happens is, whenever we purchase the goods, obviously after the purchase of goods, after the purchasing of raw material, we have to produce them, we have to convert them into the finished goods. So the question arises, are we capable enough that are we utilizing the goods, the stock properly or not? Whether all the goods which are being manufactured are being taken care of on a timely basis or not. Isn't it like that the goods which we have purchased are kept idle in the office? This should not be the scenario. So be it the raw material, be it the work in progress and the finished goods as well, the inventory left with us should be very much less, because more the inventory we would have, it simply means that we are not able to sell these products into the market. Or else if we have more of raw material, that simply means that we are not capable enough to produce the finished goods in a timely basis. So that's why the inventories should be less. So with this ratio, we come to know that are the inventories getting utilized in a timely basis or not? Okay. So the formula, as I told you, so the cost of goods sold, the formula for cost of goods sold is the opening stock plus the net purchases plus the direct expenses minus the closing stock. It is basically the cost of the goods which we have sold into the market. Let me tell you an example. For example, in the full month, suppose we are taking an example for a month. In the full month, we have purchased the goods, we have purchased the raw material worth of 5 lakhs. Apart from that, we already had the leftovers of the previous year, suppose rupees 1 lakh. So in total, we have a raw material worth of 6 lakhs. That is 1 lakh for the previous year and 5 lakhs for the current year. So this is how it has become 6 lakhs. Now for the production purposes, we spent some amount on paying the wages and some amount on the carriage inward and the direct expenses as a whole. Suppose we have spent rupees 3 lakhs into these things. So now can you please tell me the exact amount which we have spent on production of these goods? Exactly, it's the correct. That is, it has become 1 lakh plus 5 lakhs plus 3 lakhs. So total has become 9 lakhs. So it is 9 lakhs worth of goods which has been produced. Now there can be two scenarios. Either we will be able to sell these goods, or else the goods will be left with us only. That will be the unsold goods. So suppose from the 9 lakhs goods, we were able to sell the goods worth of 7 lakhs. Now, if we were able to sell the goods of 7 lakhs, so that simply means that we would have the closing stock of the goods worth of 2 lakhs. Am I correct? Now, so the question arises, what is the cost of goods sold? Exactly, it's 7 lakhs. How come? Because out of the production of 9 lakhs, we have only sold the goods costing 7 lakhs. So it's 7 lakhs worth of goods which has been sold into the market. Might be possible we would have sold that 7 lakhs worth of goods for rupees 8,50,000. So ultimately, what's the cost? The cost for that particular goods that have been sold in the market is only 7 lakhs and it is not 9 lakhs. That's why the formula is opening stock plus net purchases plus direct expenses minus the closing stock, because that's the stock which is left with us, which is unsold. So that's why it has to be deducted from the ultimate amount of the production cost. So with this, we have completed the formula for calculating the cost of goods sold, that is also known as the cost of revenue from operations. Now, what is the meaning of revenue from operations? Revenue from operations simply means the sales only. So that's why if we can call it cost of goods sold or cost of revenue from operation, it's one and the same thing. Is it clear now? Now, if it is clear, now we'll move on to the denominator part. The denominator is the average inventories. Now, what is the meaning of average inventory? Average inventory is the amount of inventory which is maintained throughout the year. As I told you, this should be very less. Why? If there are more inventories, that simply means that we have blocked the maximum amount of our cash into that inventory only. So that's why it should be less. So the formula to calculate the average inventory is opening inventory, that is the inventory at the beginning, plus the closing inventory, that is the inventory at the end, that is the closing stock also, divided by 2. With this, we will be able to calculate the average inventory. So this was the formula to calculate average inventory, and as a whole, we have found the answer for our question, for our ratio, that is cost of revenue from operation upon average inventory. Now, this was the formula. Now let's come to the ideal situation. As such, there is no ideal situation for this thing. There is no ideal ratio, but more the ratio, better it is. That is, higher the ratio, better it is. Now the question rises why? Obviously, the availability of the inventory should be less. The inventory which is available with us should be less as compared to the production cost. Okay? So that's why higher the ratio, better it is. So this was the completion of the first formula, that is inventory turnover ratio. Now let's come to the number 2 part. The second ratio is trade receivables turnover ratio. Trade receivables turnover ratio simply means, now tell me, what is the meaning of trade receivables? Trade receivables are the persons from whom we have to receive the amount. Why do we have to receive the amount from them? Because we might have sold the goods to them. That can be the debtors, the bills receivable. These are basically our trade receivables. Okay. Now, if we have to receive the amount from them, so why do we have to receive the amount? Because we might have sold the goods on credit. So the formula is net credit revenue from operations upon average trade receivables. Obviously, we will compare the trade receivables with the credit sales done in the full year. So, what is the meaning of a net credit sales? Net credit sales simply means that the goods which we have sold in the full year on credit. That is the meaning of net credit sales. So, how do we calculate that? So, it is basically from your total sales, the total sales we have done in the full year or in the full month, for which time period we are calculating the ratio, minus the cash sales and minus the sales return. These both are deducted from the total sales in order to calculate the net credit sales or the net credit revenue from operations. So this was the numerator's formula. Now, the second one, that is the denominator, is basically the average trade receivables. So it is same as we did for the inventories, that is the opening trade receivables plus the closing trade receivables upon 2. Okay. So with this, we have completed this formula as well. Now let me just explain why are we calculating this ratio. So the purpose to calculate this ratio is to know, as compared to the sales done in the full year, how much of the amount is still recoverable. What is the amount which has to be recovered still, which is unrecovered till the date. For example, let me explain you with an example. Suppose there is a company who has sold goods worth 50 lakhs in the full year, and that too on credit. Okay. Now the average trade receivables, that on an average we have to receive an amount of 10 lakhs in a full year. That is, always there is a debtors of 10 lakhs available with us. Is this company good? Or the second company has also sold the goods worth of 50 lakhs, but on an average the debtors which are available in the business is only 5 lakhs. They only have to receive 5 lakhs from the debtors. Okay. Now tell me, which company is the best? Obviously, you will say the second company. Why? Because the second company has the low debtors. That simply means that the other amount has been recovered and there are less chances of loss. Because as we all know, that debtors might be converted, might be the bad debts, might become the bad debts. That's why it should always be noted, the less the debtors, it is better for us. Okay. Now, there can be a thought in your mind that debtors are our assets, so it should be more. The first scenario is good. Not at all. The first scenario is not at all good, because there is always a chance that our debtors might get converted into the bad debts. And apart from that, if at all you are getting the money from debtors, is it good or not? Obviously it is good. If you are getting the money from your debtors on a timely basis, is it good or not? Obviously good. If the debtors are not able to pay the amount, if the debtors are, just telling you that come after a month, come after 2 months, so obviously that simply means that we do not have the cash surplus with us for purchasing the goods in the market. So that's why the less debtors, the more is the ratio good. So with this, we can say higher the ratio, better it is. Okay. So with this, we have completed the second ratio. Now, let's move on to the third ratio. The third ratio is trade payables turnover ratio. As we studied the trade receivables ratio, it is just the opposite of it. This is the trade payables ratio. Now, can you please guess the formula for this? It is as easy and like the same as we did for the trade receivables. Now, the question is, who are trade receivables? Trade receivables were the person from whom we had to receive the money. Okay, so they were connected with the credit sales. Now, the trade payables turnover ratio has to do with the trade payables. Now, who are trade payables? Trade payables are those person from whom we have purchased the goods on credit. Now, if we have purchased the goods on credit, so it's always a liability, obviously a liability to whom we have to pay the amount, to whom we are liable to. So those are basically our trade payables. And with whom are they connected? Exactly the goods which we have purchased on credit. So the formula for this is net credit purchases upon the average trade payables. So the net credit purchases is equal to total purchases which we have done in that period minus the cash purchases minus the purchases return. So this was the formula to calculate the numerator. Now let's talk about the denominator. So it is the same, that is opening trade payables plus closing trade payables whole upon 2. So this is the formula to calculate the denominator as well. So with this, we come to know that whether we are able to pay the amounts to the creditors on a timely basis or not. So basically this ratio is checked mainly by the creditors or the trade payables of our company. That is the company able to pay the amount or not. So obviously for us, if we talk about the company as a whole, so more the creditors, it is good for us. But when we talk about the creditors' point of view, they also want the amount back from us. So that's why they will say that less the creditors, it is better for the company because the debt is less. Okay, so I would not say any of the ratio here. There is no ideal situation, nor I will say that higher the better or lower the better. It is just the ratio. Okay, so this was the answer. This was the ratio. We covered number 3. Now let's move on to the next ratio, that is your working capital turnover ratio. What is the meaning of working capital? Working capital is the amount of capital which is required by the company on a daily basis for its day-to-day expenses. The amount a company spends on paying the wages, purchasing the goods. This is basically the working capital requirement. So this working capital is compared with the sales which we have done in the full year. Now, for example, suppose we have to produce a goods worth rupees 100. Now, let me tell you the bifurcation of rupees 100. Where do I need to spend this amount? The first amount is rupees 50 rupees I want for the procurement of the raw material. I will purchase the raw material worth of rupees 50, and 30 rupees I will have to spend on paying the wages to the laborers who are producing the goods, and the remaining 20 rupees will be spent on the extra other expenses which are done in the factory. Suppose the direct expenses. Okay. Now, what happens? To produce the goods of rupees 100, obviously I need to spend rupees 100. I need to pay the cash of rupees 100. Now I'm giving you 2 scenarios. Tell me which scenario is better. The first scenario is I have the credibility, that is I can purchase the goods on credit for rupees 50, and my laborers are good. So if I pay them after 15-20 days or after a month, they are happy with me. So they give me a credit period of a month or 2. That is both of them, the creditors also and the laborers also. Next, but to do the other expenses, I have to pay the amount immediately. That is for rupees 20, I need the cash. So in all, to produce the goods of rupees 100 or else to sell the goods of rupees 100, I just need to have 20 rupees in my pocket. This is the first scenario. The second scenario is that I have to produce the goods worth of 100, for which again I will need a raw material of 50 rupees, 30 rupees for the wages, 20 rupees for the other expenses. Now, I don't have much of the credibility, so my creditors said that we won't allow you a credit period. We want the cash immediately. So we will have to pay 50 rupees immediately. And let's talk about the wages. So the labor also said that after the completion of the work at the end of the day, they want the wages to be paid immediately. Last is the expenses, which has to be paid immediately. So in order to produce the goods worth of rupees 100, we will have to pay the full 100 rupees immediately itself. So now tell me, which company is better? The first company, which only requires rupees 20 for the production of goods, or the second company, which requires the full amount of 100 for the production of goods? Now, there might be a confusion in your mind that obviously we will have to pay the amount in future. So the first company is better because they are paying the amount immediately. Sorry, the second company is better because they are paying the amount immediately. Am I correct? But just imagine if at all you don't have the amount with you, if you don't have the money with you, so that simply means your production will totally stop. So isn't it a bad situation? So obviously the first scenario is good, where the working capital requirement, that is the immediate cash requirement, should be low. So this is the scenario. That's why we study the working capital turnover ratio, with which we come to know that whether the company's production can be done with a low working capital or not. Okay. So the formula for this is net sales, that is net revenue from operations, upon the working capital. So net sales is the total sales minus the sales return, and upon working capital simply means the working capital formula is equal to current assets minus your current liabilities. So with this, we have finished the fourth ratio as well. Now, let's come to the next ratio, that is the fixed assets turnover ratio. Now, what is the meaning of fixed assets turnover ratio? First, tell me, what is the meaning of fixed assets? Fixed assets are those assets which are basically the non-current in nature, which are kept for the use for a longer period of time and are not kept to be sold in the near future. Obviously, we get a benefit out of them and we use them. Like for example, we have the machineries, we have the plants, we have the building, land, and so on all. So these are basically the fixed assets. Now the question arises, why do we purchase the fixed assets? The fixed assets are simply purchased so that we can get a benefit out of that. For example, why do we purchase a plant and machinery? We purchase a plant and machinery so that we can do the production work, so that the goods can be produced. And after the manufacturing part, we can sell the goods into the market. So it helps in selling the goods. It helps in production of the goods. That's why fixed assets are a benefit in a future and a longer term. Now, this ratio is in connection with the fixed assets, with the connection with the sales. So, are the fixed assets which have been employed in the business generating enough cash inflows? Are they generating more sales? Are they letting the more sales to happen or not? This is the main scenario to check in this ratio. So the formula for this ratio is revenue from operations upon fixed assets, that to the net one. Now, what is the meaning of net fixed assets? Net fixed assets simply means that the assets should be net of depreciation. That is, it should be the net of depreciation. Simply means the depreciation should be deducted from the fixed assets amount. Okay. So this was the formula for the fifth one, which calculates whether the fixed assets involved are generating more sales or not. Now let's come to the last formula, number 6, that is the net assets turnover ratio. Now, what is the meaning of net assets? Net assets simply means the capital employed in the business. Net assets simply means the capital which has been employed in the business. Okay, so what is the meaning of capital employed? Capital employed's formula is equity, that is the shareholders fund, plus the non-current liabilities. So with this, we have to calculate the capital employed, and it is checked with the revenue from operations. That is, whether the amount invested in the firm is sufficient to generate the sales or not. Whether the amount which has been invested in the business generating the sufficient amount of sales or not. This is the main criteria to find out the net assets turnover ratio. The formula for the same is revenue from operations to be kept in the numerator, and in the denominator it appears the capital employed. Okay, so this was the formula for this ratio. Now, so we do have the betterment as well, as if higher the turnover ratio means the better it is, and better the firm is utilizing its all of the funds. So this was the answer for this solution, for this ratio. I hope you have understood all of the 6 ratios which are there in the activity, that is the turnover ratios. Thank you so much.